This conference will now be recorded.
Hi, this is Julie at InSmart, and I am going to spend the next 45 minutes or so to walk through the input steps you need to complete to create a basic and a classic Wealthy and Wise workbook. The case is going to analyze for a couple if acquiring an IUL insurance policy is going to make sense for them. First of all, it's going to find out if they do have the cash flow for the premium. And second, to find out whether adding the IUL insurance policy is going to enhance their net worth or enhance their spendable cash flow. So you need to go find the InSmart Systems shortcut on your desktop and double click on it. And then you're going to select Wealthy and Wise System by clicking on this little icon. And it's going to launch the system. You get a little quick start note, which can be selected to not pop up every time that you open the system if you wish to do so. This is kind of a reminder note about the tutorials available. So if you're familiar with the content, you can click here to hide this tutorial, okay? And then continue. You get a quick start menu. So click on Create a New Client Workbook. A workbook basically means a case study for a client. So we're going to create a new client workbook. Click OK. And then you get the client data screen. This is the initial input screen for the case. Basic client data. Client workbook description. You will normally use the insured's or the client's name. So in this case, the made-up couple, their names are Robert and Samantha Lee. So next step, client information, the name. For the client is Robert Lee. He is 45 years old and he will retire in about 20 years. That's the plan. He is male. And then you include the spouse data and her name. And she is 40 and she is going to retire at age 65. Okay? Now, tax bracket. I'm going to use 33% for both the pre-retirement years, which is going to be from 45 to age 64, and the retirement tax bracket, which is going to be the tax bracket starting at age 65. So I'm also going to use 33. The heirs tax bracket, I'm going to use 33 as well. Capital gains tax rate is 20. You obviously would use higher or lower number that's appropriate for your client when you're doing your real case. This is just an example. Life expectancy, because I'm doing the case for a couple, I'm going to use joint life. And I'm going to run the proposal for about 50. You can do it either till age 90, till age 100. But here I'm just going to run it for 50 years till about the mid-90s for the client. Okay, to save the screen and to proceed to the next step. So now you're in the scenario start screen. This is create a new scenario from scratch. The name of the new scenario. This is the baseline. So I'm going to name this Plan 1. Current retirement plan. This is the status quo scenario. We're just doing a basic cash flow analysis by inputting the data regarding the income, expenses, and assets. So name the scenario and click OK. And now you're in the very first screen, preliminary data, and it shows here Plan 1, current retirement plan, analysis of these are okay. You can change it if you want, but I'm okay with these naming. And next step, design cash flow. This is the first data input. So this is about their lifestyle need, okay? And you've got, living expenses, and you can show travel, college tuition, and so forth, all down here. However, I will point out here the cash flow option choice that you need to make. You can show everything as spendable. So anything for mortgage payment, car payment, insurance premium, everything is going to be not differentiated and treated as spendable. But sometimes we may want to differentiate the consumption type of expenses, like for housing payment and groceries and so forth, as spendable because those are spent and then they're gone. But there are certain types of expenses, if you treat it as dedicated, it's going to separate it out from the total living expenses. For example, life insurance premium. I think it's going to make a better report and a better case if you select this. Okay, and I will show you the differences in the report later. But for the time being, make sure you select this. Show cash flow categorized as either spendable or dedicated. And then living expenses, include, check include, and we're treating living expenses type of cash flow need as spendable cash flow instead of dedicated, okay? Spendable cash flow schedule. And they want, in this example, $250,000 in all retirement years. And when you hit the apply button, it's going to populate this column for you. So $250,000 in all retirement years, apply, and then you see the numbers show up here, starting at age 65 in year 21, $250,000. I also want to use an inflation assumption, and this is the input area for that. If you do 3%, that's the assumption that I want to use. If you do 3% here and hit apply, it's going to start the inflation assumption from year 1, okay? And by year 21, the 250 is going to grow to a huge number, which is like this, 3%. Apply, and see 250 jump to 451 the first year they start their retirement, and it's going to be over $1 million. This is a gigantic number, which is not what I want to use. So this is what you can do. You do 0, apply. Now we're back to 250, but I'm going to use a second rate starting here. So basically, I want to have the 3% arising on these numbers. So I'm going to use a second rate at 3%, starting at age 66. Apply, And then you see these are the numbers that's got the inflation added on top of the need. Okay, so okay to save. And I'm not going to show anything else because the 250 is supposed to cover everything that they need, including, housing payment, travel, and whatever. So everything is lumped together as living expenses. In the second scenario, when I'm going to add an insurance on top of it, that insurance premium is going to be treated as dedicated. But this is current retirement plan, baseline, with nothing proposed yet. Okay? Desired cash flow. Second input, expected cash flow. And this is an area where you enter the income streams that they're going to receive. So here, this is not a liquid asset, but an income stream. So include expected cash flow. Down here, include Social Security. That's the first item. And I click on schedule. And they're 20 years away. They don't know what kind of Social Security benefit they're going to get. So I'm going to use this embedded Social Security calculator. Okay, Social Security. Click on it, and you get an input screen that's specifically for Social Security benefit calculation. Now, what's his date of birth? Let's say his date of birth is August 1st, 1973. And he wants to collect at age 67. And Samantha's date of birth is July 15, 1978. And that will make her 40 years old as of right now. Okay? And collect the retirement benefit at age 67. And they both work. So he made over $128,000. That's his working income. And she works too. So you add a check here. And she also makes over this amount. So I picked this one. This is the income level. And when they retire, they estimate they're going to have taxable retirement income of over $44,000. So these data are entered into the screen, and you click on OK. It's going to then populate this column for you with the calculated Social Security benefit. So OK, and see down here, we've got the data. These are the Social Security benefit. For him first, because he is at 67 in year 23. And then a few years later, by her age 67, you're going to have his Social Security plus hers. So as of this year, the $49,000 is his and her Social Security benefit. So when you're doing a case for a couple, you can run the Social Security calculator together for them both. So you don't have to run one time for him, one time for her. This one, you just do it for a couple. And I also want to add an inflation. This one, I'm going to add 1.5 and apply. It's going to increase the Social Security benefit. Okay, these are the numbers. And okay to save. And they don't have any other income besides Social Security. Next, we deal with the investments and savings. So these are the liquid assets now. Retirement plan asset is where you enter their RA or 401k, Roth, and so forth. So these are the qualified accounts. So retirement plan asset, and then first you deal with defined contribution for the client and add an include button. This is for client Robert Lee, and he has 180. Right now, that's what he has saved in his 401k. And the yield is 7%. That's the number that I use here. And look over here, deferred income tax options. These are, again, report options. If you have this box checked, when you see in the net worth report, this 401k, the total value is going to show a net amount. So it's less than the gross. It's an option, and you can choose to either show net values, which is really what the client has, versus the gross amount. The gross amount will show up in the value regarding this defined contribution asset if you deselect this box, okay? And I'm going to choose to show gross value for the time being. And he can add more contribution while he's working. So schedule additional contribution, schedule, and let's say he's going to contribute about $10,000 every year until he retires. This is until age 65, okay? So that's the additional contribution going into his 401k. And that's it for now. I'm not assuming that they have anything else here under retirement plan asset. But they're savers, so they have saved quite a bit of money in the liquid assets, non-qualified account. First one under liquid assets is taxable, and he has a taxable bucket. You can name this report, something like some kind of a taxable vehicle. You can name the account. Estimated value is $500,000, and yield is 4%, and they're not adding more money. They're not adding more additional savings. So that's for taxable account. They also have tax-exempt account. You can, again, custom name this, some kind of a muni bond or something. But they have two. If you want to name it, just type in the name. Okay? So they have 250 here, and its yield assumption is about 3%. This is for the tax-exempt bucket. They also have stocks and mutual funds. So this is, again, under liquid asset. We did taxable, tax-exempt. Now we're adding equity account. So check, include, and they have $500,000. Cost basis is assumed to be $350. And they are also still putting more money away into the stocks and mutual funds, the equity bucket. So additional deposits. And you click on schedule, and now you show how much they're saving every year in the investment fund. So I'm assuming they're putting aside, investing an additional $35,000 per year until age 65. So this is the savings part. This was here, okay? Growth, let's say it's 7%. You can add management fees too to these. So let's say 0.75. And portion of long-term growth, I would say 75. They're relatively conservative. And portfolio turnover, I'm only using 40%. And that's it. This is the equity account. Next, we deal with illiquid assets. They have house. So under illiquid assets, check, include illiquid assets. All of these tabs now are activated. When you green check, these, if you do not green check, these are all faded out. Okay, so green check, illiquid asset. First one is principal residence, and then you have these other assets where you can show if they have rental property, vacation home, and all that stuff. So under illiquid asset, check principal residence, include principal residence, and the house is worth $500,000 right now, and it is in a appreciating market, so it's assumed to be growing at 5%. And there's a mortgage remaining, so you add the mortgage by checking this box, illustrate loan. It is an amortized loan. Outstanding balance of the house on the mortgage is $400,000, and 20 years remaining. Mortgage interest is 4%. Okay? So we dealt with the mortgage. Their current retirement plan is to sell the house when they retire and then downsize to a smaller house. So I'm going to go over here where you have sale of principal residence. You check, assume the sale of the principal residence in year 21. They are retiring in year 21. And push the enter key, watch the sales price change, because by then the house would have appreciated to a much higher value. So in year 21, enter, and that's going to trigger the the future sales price, which is $1.3 million. Cost basis $400,000. They bought it for that. Excludable gain is $500,000. So now, how are they going to buy a smaller house? You go down here where it's for replacement residence. Okay, so we're going to replace this residence with a new house that's going to be costing them, let's say, $600,000. Okay, this is the net that they're going to realize out of the sale of this house. Cost of the residence is $600,000. So in year 21, there will be about over $600,000 extra money that's going to be realized by doing the downsizing. And the new house is assumed to be growing at 3%. Okay? And they're not doing a new loan or mortgage. They're just buying a house when they retire, and they're going to realize a chunk of money. So where is that $600,000 extra money that's going to be left over after they buy a new house? Where is that money showing up? It's going to be based on how you deal with extra cash flow reinvestment, how you direct the program. And I will show you. It's going to be here, okay? Illustration details and excessive cash flow. So let's go back to illiquid assets. So we complete the input for the principal residence, the mortgage, the future sale, the downsizing. Okay. Next, they also have some personal property. Okay, and that's $400,000. And these are depreciating assets, so you can enter a negative yield that's going to show this value declining, negative 5%. No loans on this. And next, they have one more item. So you go to asset number 3, check include, and it shows up as reinvestment, investment real estate. But this is not correct, not the default correct name. So I'm going to change it by clicking on this down pointing arrow for the drop-down menu, select Customize. Now you can type over it. And what they have is art collection, not real estate. Okay, so change the name to reflect that. And it's about $100,000 right now. And it is growing in value at 7.5. Okay, so that's the 3 illiquid assets that's entered under Illiquid Assets tab. Do they have other assets such as life insurance? Right now they don't. This is the current plan, okay, the baseline. They don't have any life insurance. If they do, for example, in-force policy, term policy, you can add them. But in this example, they don't have any. And illustration details. Excess cash flow and reinvestment options. So when there's extra money in any given year for any reason, you need to select where that money is going to be reinvested in. And then you have these liquid assets that become available because they were activated here. Okay, you've got a taxable, tax-exempt, and equity account. So here, under reinvestment options, I'm going to select equity account, and I'm not going to divide them up, 30% here, 40% here, and so on. I'm going to just put 100% when there's extra money into an equity account, only 7%. And it's shown as reinvested, 100% here. And next, prioritize the use of assets. This is where you show the smart distribution analysis, okay, how you run that analysis. You do need to pick out of these 3 options, one of the 3. So let's say we're going to use the liquid asset one at a time in sequence. And these are the available liquid assets. It shows up from your prior input, okay? And all I do is I click on Maximize Net Worth. And it already did the smart distribution for me and gives me this sequence of liquidation for cash flow needs, okay? And you're done. Because we're not dealing with gift here, they're not wealthy, they're not doing any gifting. This is a retirement plan. So we just skip these and come here. We did the reinvestment option. We did the prioritize the use of assets, smart distribution analysis by clicking on this button. And you get a whole set of reports. By clicking on report selection, you click on use system defaults. Okay, and it's going to pick and choose those reports that we recommend. The blue line reports are summary key reports. All the red line reports are backup detail pages. Okay, so cash flow analysis, wealth transfer, and so forth. I won't have time to go over these reports, but this is how you create this very first scenario. And you click on the Done button. Now you see you're on the very first window, the main window. By age 94, they have about 8.1 million in their net worth. So the study is going to find out, first of all, if they run out of money or so forth. They don't. In this example, they are fine. But let's see if we can improve their current retirement plan by adding an insurance policy. So that's kind of, where the case is going to lead to. So I'm going to do scenario 2. And the scenario number 2 is going to be copied off the first one. So you don't have to redo a lot of input. So what I'm going to do is to go to here where you have the new and copy and all these buttons. You click on new. We're going to do plan 2 now, new. And I'm not creating a new scenario from scratch because I've already built the first one. So I'm going to copy the first one and edit it. So copy an existing scenario and edit it. And which scenario I'm going to copy? Plan 1. So I'm going to name the new one that I'm going to create as plan 2. So I'm going to say add IUL. Okay, this is, we're actually just right now copying the first one. So right now, everything is identical to the first plan, the current status quo, because I haven't made any changes yet. But by copying it, you don't have to redo all of these data input. The assets they have are still about the same. The only thing that's going to change in this add IUL scenario is they're now going to have a proposed life insurance policy. So you go to other assets. This is the only input change I'm going to make, okay, in the second scenario. And go to other assets, check, include other assets, make sure it's inside the estate, not outside, inside the estate, and check include, not current life insurance, but proposed life insurance. And you click on the schedule button. And now this is the table where you enter premium, cash value, loans and income, death benefit. And there's an import button. You can type in the data in or copy and paste from PDF. However, I've already got a proposed insurance run and copy and paste it in the source data. So if I click on the import button, guess where that leads to? Let's see. Click on import. Now I am in the source data file. Okay? See? I was here. I click on the import. I get to the source data where all my life insurance data is stored. And this is the proposed policy for Robert. Okay? It's proposing $15,000 premium, getting him, and this is what the data, 20 pay, okay, and retirement income distribution, cash value, surrender value. We get these data from the insurance company. So we're going to propose him that he invests in this IUL, and click on the source data that you want, so it's highlighted and selected. Click OK. Now we just imported the whole insurance source data. And you see this retirement income distribution, the cash value, surrender value, death benefit. The premium is going to be 20 years of $15,000 per year. But look here, okay. Show any premium as dedicated cash flow. This is correct. I'm not treating the $15,000 as consumers kind of expense, okay? It's supposed to be producing these kind of value for them. So these two boxes are checked correctly. Dedicated cash flow. Okay. Okay to save. And now you've got the insurance policy in. And you just created plan 2. Click on done to save, or go and order those reports. It's too many reports for a second scenario, so I'm going to just pick and choose those that I'm going to need. Cash flow analysis, net worth maybe, and transfer. So I'm just adding these reports to reduce the number of pages involved. So I've got now plan 2 made, okay, add IUL. And you see here, by year 94, net worth jumped to 11 million versus the current status quo, no insurance scenario. And wealth to heirs, due to the death benefit part, is got to be $3 million more. And liquid asset also improved. So this is going to tell me that adding the IUL policy is actually going to enhance their liquid assets as well. And when you have more liquid assets, it means that they can spend more money, right? So I'm going to then do a third scenario by creating Plan 3, okay? The Plan 3 is going to still show the IUL, the same IUL, but we're going to present the benefits of having the IUL from a different approach, a different perspective. And I'm going to copy the scenario again and name it Plan 3. Plan 3 is going to be created like this. Click on New and Copy. I'm going to copy and make sure you pick the right scenario that you're going to copy from. Here, I am going to still show an IUL. So Plan 3 is add IUL plus more spendable. Okay, that's the difference. I'm going to basically kind of stress test it and see how much more income the clients can get by acquiring this IUL. Plan 3. So right now, Plan 3 is exactly the same as Plan 2, and I'm going to make one change in the input. I'm going to go to Desired Cash Flow. And under Desired Cash Flow, you have the 250 index at 3%, right? I'm going to add a second Include button. Select from the drop-down menu, Additional Spendable Cash, okay? And these are, again, spendable, not dedicated, okay? And I click on Schedule. I'm going to now use a calculator, okay? This is a hidden calculator. You need to make sure you are in Desired Cash Flow. Check Schedule, then this table pops up, and you have access to this cash calculator. And this is going to be, I want to find out once they retire from year 21 and till year 40. So basically for 20 years when they retire, the first 20 years of their retirement. If we I'm not going to use inflation here, so let's ignore that part, okay? So you establish a time range. This is for 20 years after they retire, year 21 to age 40. And then the net worth, I want to maintain it for the same as current status quo. They have about 8.1 million. Okay, so I need to type in, you can do 8.2 million. I'm going to just do 8193006. So if we maintain the same level of net worth as the do nothing scenario, and I hit the calculator, it's actually showing me that they actually can get another $54,000 every year to spend for 20 years. And you click OK, it's going to populate these columns now. This is the extra spendable cash flow these clients can get due to the fact that they acquired this IUL. It's really like an asset reallocation. They get it to an IUL, and due to the efficiency of that strategy, it produced more spendable cash flow, okay? The only change I made in scenario 3 is stress testing the liquid assets that they have available to see how much more spendable cash it can produce for them. And again, you go to do report selection and so forth. Pick those reports that you want and click on the Done button. Now you got 3 scenarios now. See here? Plan 2, by adding the life insurance, net worth gets enhanced. But what if the client say, I'm okay with my kids getting about 7 million, 7.5 million. What's in it for me during my lifetime by doing the strategy? And this is what we're doing. And you see here, the naming here, I should have typing in here plan 3. So you can edit it, okay? And all you do is you click on it twice slowly. You see, it becomes editable. Don't double click, but just click on it once, twice, slowly, and now I can make the text, the naming of this kind of consistent. And you see now it's really nicely listed. So you start with current plan, no life insurance baseline, just maintain your status quo. And they are doing fine. They don't run out of money. They have quite a bit left for their kids and so forth. By doing the insurance, the net worth increase and liquid asset also increase. So I'm going to then add plan 3, and it shows net worth. See, between this one and this one is really basically the same, but by doing the IUL, they get more spendable cash flow. You cannot see the additional spendable cash flow from these numbers, but a nice way to see the differences between the 3 is to create a comparison. And you go down to the comparison screen. The lower half of the screen, you see the new button now becomes available. Once you create more than one scenario, 2 or 3 or more, this button for creating new comparison becomes activated. So you click on new and storage name. I'm just going to call this comparison. And you see here, it's analysis of comparison. And you now go down here to select and order the way you want to set up the comparison. First choice, I don't want to be the plan 1. I want it to be I don't want it to be plan 2. I want it to be plan 1. Let's start with the baseline. So no IUL or something, current situation or whatever. You name this, okay? Second choice would be plan 2, add IUL. And third plan is correct. I'm going to do IUL plus more spendable cash. More cash flow. Okay, so you just name these, and it's really, really easy to do a comparison. Once you select which 2 or 3 scenarios you're going to compare, you can basically progress to report selection, use system defaults, and you get this kind of report. Okay, it shows you the do nothing, the insurance as in strategy 1, net worth jumped. And scenario 3 is that we're kind of keeping it the same. The line is the same as the current situation, the no insurance scenario. However, down here, look here, this is the value in doing the plan because it's producing more cash flow. Cumulative spendable cash flow provided by age 94. They get over $1 million to spend by doing the insurance, while the net worth is about the same. So you're not reducing your net worth by spending more. And well, the heirs are kind of about the same. If you spend the same amount of money, then the kids get to inherit more. But what if the client says, you know, my kids are fine with $7 million, and so you show them from a different perspective the value of doing the plan, which is more spendable cash flow. And then we're going to have all these other reports, and this one here is also a key report. It shows to the client, current situation, you are doing fine. You get about 11 million spendable cash flow. By adding the IUL, while not increasing your lifestyle expenses or standard or you get about, you know, more wealth. This is your comfort zone. This is what the kids will get. So it's really enhanced this way. But if you maintain the same level of net worth and wealth to heirs, it actually produces more spendable income for you. And you got the case done. You've now created 3 scenarios plus a comparison. And when you produce reports, let's say you want to produce a PDF file that can be emailed or printed, you have right here four different sections, segments, and each one is going to produce a set of reports. So there are actually 4 individual sets of reports, and you don't want to create 4 different PDFs with lots of pages and give it to the client. What you can do is, instead of click on the print button in these 2 areas down here, once you've got the whole case made, preview or print entire client presentation, which is going to get all of the 4 sets of report nicely organized. Okay, so there are print, and print. So each one is for each section. But if you want to print the entire workbook, click on this one. And then you are going to add all probably here. So there's plan 1, plan 2, plan 3, okay? And then the comparison. Bob likes to suggest that you show the comparison pages first when you organize the reports. So these are the results page showing people what happens by implementing the new plan. And these are all the backup pages, okay? So that's under the selection of your proposals. Then go to add a cover page. And you need to make sure the naming is correct, right? So this is Robert and Samantha Lee. Okay? And then you add these, and you could select your cover pages. This one versus this one. And select that, and make sure include cover page is checked. Okay? Organize your presentation. You can add a table of contents, add section pages, and now you can preview before you print or save. And it's like this, cover page for Robert and Samantha Lee. And then table of contents showing the comparison results page. And then these are the backup pages and so forth. And then you can print to PDF and save. I'm going to not print to a printer, but print to PDF and print. And now you've got the case. So, or Lee workbook reports or something, you name this, okay? and save it to a place where you can find it and save. See, you just created this big report showing all 3 scenarios and all of the data and their comparisons. This is now a PDF file, which then you can email to the client. Okay, and then you close and you can exit. This is how you create from beginning to end 3 scenarios and then their comparisons. And that's the way it's done.